If you're a small business owner in Canada, especially here in Alberta, you probably already know this. Retirement doesn't come with a handbook when you're self-employed. Mostly everything you need to create on your own. You're the catalyst of your own success. So you focus, you get down to work, and hopefully build a successful business. You pour everything you have into it, heart, sweat, soul, and money, looking after everyone and everything. But who's looking after you? In fact, many business owners I work with tell me they put so much into their company, they're not even sure how they'll eventually step away. And that's the catch. You can have a thriving business and still be completely unprepared for the retirement you want. So the real question becomes, how do you build a retirement plan when your business has been your retirement plan for decades? Whether you plan to sell your business, pass it on to family, or simply slow down and live off your investments, your strategy needs to start well before your exit date. Because without the right structure, taxes, timing, and transition planning, you could end up with more uncertainty in retirement than you ever had while working. In this video, I'm walking you through a roadmap that every small business owner in Canada needs, especially if you want to retire on your own terms. Let's talk about how to turn your years of hard work into lasting financial independence. Hi, if you're new here, my name is Stefano Francesca, and I'm a certified financial planner professional at Next Step Wealth, proudly partnered with IPC Securities Corporation. For over 30 years, I've helped Canadians, including many Alberta-based business owners, transition from working in their business to living off the wealth that they've built. If you find this video helpful, be sure to like, comment, and subscribe. And if you're ready to get personal advice, the link to book a call with me is below. Now, let's break down what retirement looks like when you're your own boss. Part 1. Why traditional retirement planning doesn't work for business owners. When most people think about retirement, they imagine a pretty standard playbook. Contribute regularly to a company pension plan, build up RRSPs and TFSAs through payroll deductions, stop working around 60 to 65, and start drawing from a mix of pensions and government benefits. But if you're a small business owner, you know that none of that applies to you. There's no automatic pension, no matching contributions from an employer, and often no separation between business money and personal money. Instead, you've likely been doing what most entrepreneurs do, focusing on growing your business, not your retirement saving. And that's totally understandable. Reinvesting profits back into your company might have felt like the smartest move. After all, your business is your livelihood. And for many years, it's also your largest asset. But here's the problem. Your business might not be enough to retire on. Let me explain. Many business owners assume they'll simply sell the company and use the proceeds to fund retirement. And in some cases, that can absolutely work, especially if the business is well established, profitable, and not overly dependent on you. But in reality, three things often get in the way. One, your business may not be worth what you think. You've poured your heart into it, but buyers look at profitability, scalability, and how dependent the company is on you personally. If you're still the face of the business, it might not sell for as much, or at all, without a solid transition plan. Secondly, you may not sell when you want to. Sometimes the market isn't right, or a health issue speeds up your timeline, or a recession hits and valuations drop. Relying solely on a future sale introduces uncertainty and stress at a time when you want the opposite. Thirdly, you might not want to stop entirely. Many business owners want to slow down gradually, not go from full time to full stop. That changes your income needs and the role your business plays in retirement. So instead of treating the business as the only retirement plan, what I recommend to clients is this. Your business should be one piece of a broader strategy, not the entire plan. That means creating a retirement roadmap that includes investment accounts outside of the business, like RSPs and TFSAs, tax-smart withdrawals from a holding company or corporate investments, real estate or passive income streams, and yes, an eventual exit or succession plan, but with a clear backup strategy. Why is this so important? Because I've seen too many business owners reach 55, look at their business and realize they're not sure how much they'll get for it, they haven't saved enough personally outside of the company, and they don't have a tax-efficient way to convert business value into personal income. That's where real financial planning comes in. It's not just about numbers on a page. It's about making sure you're not trapped in your business longer than you want to be. So if you're self-employed or running a small business and retirement is starting to cross your mind, even if it's 5, 10, or 15 years away, the best time to start planning was yesterday. The second best time? Right now. Part 2, building a personal retirement portfolio outside of your business. One of the biggest advantages business owners have is control over how much they earn, how they pay themselves, and how they invest. But one of the biggest challenges, lack of structure. Unlike employees, you're not automatically enrolled in a pension plan. There's no HR department reminding you, hey, increase your RSP contributions each year. If you want to retire comfortably, you have to create that structure for yourself. Building wealth outside of your active business is key to your security, because while your business might be worth a lot on paper, you might not be able to rely on it to fund your entire retirement. You may not get full value when you sell. It may take years to find the right buyer. And if something happens to you, health issues, legal problems, or burnout, that value could evaporate quickly. That's why I encourage all my business owner clients to create a personal savings program that you fully control. So where should that money go? Well, these are a few areas you can focus on. Firstly, tax-free savings accounts. TFSAs are often underutilized, and that's a missed opportunity. Every Canadian 18 and older has TFSA contribution room. And when you invest inside a TFSA, TFSA, your money grows tax-free and can be withdrawn tax-free with no impact on government benefits in retirement. This is a great place to store after-tax dollars you've already withdrawn from your corporation and can be used for long-term retirement savings, for emergency funds, or even legacy planning if you don't end up needing the money. The TFSA gives you flexibility and tax efficiency, something every business owner needs to have in retirement. Secondly, register retirement savings plans. RSPs are a great tool to reduce your current taxable income and grow investments tax deferred. But as a business owner, you don't have earned income unless you're taking a salary. Dividends don't count towards RSP contribution room. That's a big consideration. If your goal is to build RSP space, you may want to structure your compensation as a salary rather than dividends. This allows you to maximize RSP room over time, claim a personal tax deduction each year, defer tax until retirement when your income and tax rate may be lower, and create a better credit profile and other planning opportunities such as individual pension plans. RSPs can be especially powerful if you're in a higher tax bracket today and plan to retire in a lower one. They're also very powerful if you have a spouse that you can income split with. Thirdly, corporate investment accounts in a holding company. If you're using a holding company, you've probably removed retained earnings from your active company so you can better control and earmark that capital for yourself or other owners of the holdco. This can be a great opportunity to shelter income and defer personal tax. Pay close attention, however. Investment income inside a corporation is taxed at a higher rate than active business income. If your passive income exceeds $50,000 a year, you could start losing access to the small business deduction for affiliated companies. You'll eventually need a tax-smart withdrawal plan, or you could face significant taxes later. That's why the investment mix, income timing, and withdrawal strategy all need to be coordinated, ideally years before you plan to retire. With the right planning, you can use corporate class funds to minimize passive income tax. You can withdraw dividends gradually over time to manage tax brackets. You can shift capital to your personal name through tax-efficient structures. And finally, tax-exempt life insurance. Using life insurance as a retirement savings tool, particularly tax-exempt life insurance, offers several advantages, including tax-deferred growth. This allows the cash value to accumulate and compound without immediate tax consequences, potentially sheltering a substantial amount from accrual taxation. Access to cash value, which can be accessed in different ways for various needs. And a tax-free death benefit, which can also be used to provide a lump sum to beneficiaries or help cover estate taxes. Important to note that the death benefit is tax-free to your estate and bypasses probate fees, thus preserving and transferring more of your assets for your beneficiaries. At the end of the day, your business might be your biggest asset, but it shouldn't be your only plan. And more options means less stress, more control, and a better retirement. Part 3, planning for the sale or succession of your business. For many business owners, the sale of their business represents the single largest financial event of their life. And for others, it's less about selling to an outsider and more about passing the business on to family or key employees. Either way, this is not something that you want to leave to chance. Let's talk about what you need to think about years before your exit. Firstly, do you know what your business is actually worth? Most business owners either overestimate the value of their business based on top-line revenue or underestimate it by not understanding what a buyer is really looking for. The truth is, your business is only worth what someone is willing to pay for it, and that depends on a lot of variables. Is your revenue recurring or is it project-based? How dependent is the business on you personally? Are there systems and processes in place that make it turnkey? Is your client base diversified? The sooner you get a valuation, preferably from a chartered business valuator, the more time you'll have to improve it. A good business evaluator will not only tell you what your business is worth now, they'll tell you what it could be worth with a few strategic changes. Number 2, what about the tax impact of the sale? Selling a business is a taxable event, and without proper planning, a big chunk of your proceeds can go straight to the CRA. But here's the good news. If your business is a qualified small business corporation, you may be eligible for the lifetime capital gains exemption, which lets you shelter up to $1.25 million of capital gains in 2025. That means if you sell your qualifying shares of $1.25 million, you could walk away completely tax-free on those proceeds. There are conditions, including holding periods, asset tests, and business activity requirements, so it's critical to prepare well in advance. Rather than a share sale, you could have an asset sale and keep your company with the sale of proceeds in it. This is usually less tax advantageous to the seller, but still a successful sale and converts business assets to liquid assets. For higher valued businesses, you might also consider things like estate freezes, family trusts, holding companies, or a combination of all three. Each one has different pros and cons, but all of them require lead time and collaboration between your accountant, lawyer, and financial planner. Thirdly, what happens if you don't sell? Not every business is sellable, and not every business owner wants to sell. That's where succession planning comes in. If your goal is to pass the business on, whether to children, business partners, or employees, you'll need to think things through. Who's going to run it? How will ownership be transferred? Will there be a buyout or a gradual handoff? How will your retirement income be structured? Salary, dividends, or a full buyout? And what happens if something happens to you before you've formalized the plan? We've seen families torn apart and businesses dissolve simply because the plan was never documented. So if you're leaning towards succession, discussion, make it formal. Draft a shareholders agreement, establish clear roles and timelines, and consider life insurance to fund a buy-sell arrangement. Because hope is not a strategy, especially when it comes to preserving your legacy. If you're 3, 5, or even 10 years away from retirement, start this process now. You'll have more time, more leverage, and more options. And most importantly, more peace of mind. Part 4, creating sustainable retirement income with or without selling your business. Selling your business isn't the only path to retirement. And even if you do sell, that lump sum still needs to last for the rest of your life. So how do you turn your business success into sustainable, tax-efficient income that supports your lifestyle long term? Let's walk through how we help business owners design retirement income strategies no matter how they exit. Firstly, income sources to consider. Your income in retirement can be from multiple buckets. RSPs and RIFs, which are tax deferred but fully taxable when withdrawn. Individual pension plans, those are just taxed like a RIF or a pension. TFSAs for tax-free withdrawals. Non-registered accounts, providing capital gains, dividend, or interest income. Corporate retained earnings, which would provide you dividend income. Proceeds from a business sale, either lump sum, earn-out, or dividend flow. CPP and OAS, your government benefits, which can be optimized based on timing. And the cash value in an exempt life insurance contract. The right strategy coordinates all of these to smooth your income, reduce your tax bill, and protect your savings. Number 2, sequence and timing matter more than you think. If you draw income from the wrong order or too aggressively early on, you could push yourself into a higher marginal tax bracket without being strategic. You could trigger old age security clawbacks, which is just an extra tax. Deplete your advantaged accounts too quickly, thus removing flexibility from your planning long term. Here's an approach you could benefit from. Universally, we would recommend to remove shareholder loans and capital dividend account balances from your OpCo or HoldCo. This is tax-free money personally and can be set aside to create a tax-preferred income. Use a combination of non-registered tax-preferred investments, dividend withdrawals from your corporate accounts, and RSP RIF withdrawals to melt down your taxable balance. And finally, your TFSA as a buffer to top up income and create flexibility without pushing up taxes. Every person's mix is different, and Alberta tax rates combined with your corporate structure can significantly impact what's most efficient. Thirdly, what if you don't sell your business? If you're planning to keep your business or even wind it down slowly, your income strategy changes. You might continue to draw salary or dividends from the corporation. You might also remove retained earnings to a holdco and invest for passive income, or use corporate-owned life insurance to transfer wealth efficiently. You could also delay personal withdrawals to avoid excess tax in high-income years. This flexibility can be incredibly valuable, especially in low corporate tax rates and potential for income splitting. 4, work with a planner who understands owner complexity. Retirement plan for business owners is more than just do you have enough saved. You need someone who understands business structures, corporate and personal tax integration, sale and succession planning, withdrawal optimization, estate and legacy coordination, and someone who can help you map it all out, year by year, dollar by dollar. Retiring as a small business owner comes with incredible opportunity, but also more moving parts than most people realize. You've worked hard to build your business. Now it's time to build a retirement plan that protects everything you've created and helps you enjoy the lifestyle you've earned. If you're within 15 years of retirement or already thinking about an exit strategy, I'd love to help. We'll walk through your current position, your future goals, and build a personalized roadmap to get you there with clarity and confidence. Click the link in the description to start the process. Thanks for watching, and I'll see you in the next video.